Hi, I'm Dominic Picardo here for the August edition of SpreadBet magazine, and today I'm going to be looking at the case for getting back into emerging markets. Now, in the last decade, of course, emerging markets were really the place to be. What we're looking at here is the price chart of the MSCI Emerging Markets Index, which covers the returns from 21 mature stock markets. So you can see this terrific boom that we had in the heading into 2008, and then a massive recovery after 2008. So there was some fantastic returns to be had from emerging markets during that period. And of course, this was a time when the developed markets of UK, US, Japan were all struggling. For the last couple of years, though, emerging markets have really struggled since that nasty sell-off we got here in the summer of 2011. Emerging markets have never really recovered their poise. You see, the MSCI Emerging Markets Index has been chopping sideways in this broad range, and of course at the same time the developed markets like the US have been rocketing their new all-time highs, at least before inflation. So what is behind this dramatic reversal of fortunes where we've gone from a situation where emerging markets were soaring like this to ones where they're in this sideways period? Well, and you have to look at the bigger case for emerging markets, because a lot of people still say these things make sense in the long run. The emerging markets still offer much higher growth potential than the rest of the world, of course, and the developed world has much heavier debt loads at the moment. So for a lot of people this is counterintuitive, especially having gotten used to these sort of returns over the last decade or so. So one factor I think we're seeing here is the comeback of the US dollar. The US dollar may have finally have bottomed out. And what we're looking at here is the chart of the US dollar over time and the performance of developed market shares against emerging market shares. And you can see the two track each other pretty closely indeed over time. When the US dollar gets stronger, then developed markets tend to beat emerging markets. And when the dollar gets weaker, periods like this, then emerging markets tend to come out on top of developed markets. Since 2010 or 2011 or so, the dollar has been getting slightly stronger, and that has fed through into developed markets beating emerging markets. So if you think that the dollar could rise even more going forward, and I certainly think that it may well do, emerging markets could continue to underperform the world's developed markets. Still, even all that said, there are still things going for emerging markets, I believe. First of all, emerging markets are not, as a whole, particularly expensive. Working on this MSCI Emerging Markets Index, recently the valuation was pointing to returns over the next couple of years of about 10% a year, so that's not too shabby at all. Far more importantly, though, for me, there's just been an important buy signal. My momentum model, which aims to spot the best buying opportunities and profit-taking opportunities, gave a buy signal at the end of last week. And this model has a pretty good record of picking opportunities. Returns after its signals have massively beaten buy and hold over the last 25 years or so. But this model is largely for longer term speculation rather than spread bets. It's something you'd probably use an ETF to follow. However, you can speculate via spread bets on the MSCI Emerging Markets Index, or at least a fund on the MSCI Emerging Markets Index. Here is the intraday chart of a spread bet on the MSCI Emerging Markets Index. And once again, we have seen this pick up, as you can see, over the last few weeks. And my strategy here would be fairly simple. I'd be willing to take long positions as long as this line, which is the 21 4-hourly exponential moving average, is above this one, which is the 55 hourly moving average. So your buy signal effectively comes in around here when the two lines cross over. And my strategy, now that you've got this uptrend, I would be buying perhaps when every time the market sort of dips to around, say, the 13 or the 21, and then begins to rally again. That would be for me a reasonable intraday entry point, and I'd just be willing to ride that position until the market, say, got very overbought or something. As for looking for a sell signal or when to finally take profits after a long run, I would simply wait until either you've made a satisfactory profit, or we get another crossover of the 21 and the 55 average. That's a reasonable level to look at getting out of a trade like this.